welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, tonight is an educational show in honour of the public holiday, and I have to say I've noticed quite a lot recently you've been referring to continuation patterns in some of the trades that you put on for portfolios. So tonight is an educational show about continuation patterns, and for those who might have missed what they are, perhaps you could just explain them.
That's right. Continuation patterns are they're quite high probability patterns. That's the first thing to stress. And then, like the name suggests, you're looking at a stock that's in a particular trend, be it in an uptrend or a downtrend, and you're looking to try and take advantage of a pattern that is usually a consolidation, which then results in a continuation of that trend once the consolidation has happened. So just a couple of bullet points that are up on the screen here. I mean, the first one is that the trend is your friend, and that's a cliched saying, but it's actually very true. The trend is your friend because the trend implies what the momentum is, and usually the trend will continue, and usually the momentum is likely to continue. So we accept that the trend is your friend, but you use continuation patterns to try and enable yourself to time an entry to get on board the trend, because it's always very well to say the trend is up or the trend is down, but when do you get in? When do you either buy that trend or short that trend if it's a downtrend? And your continuation patterns allow you to time an entry to get on board that trend. And then, as I stressed, they are high probability patterns. All of these patterns that we're going to talk about today generally, on average, work around about 2 out of 3 times when you identify them in the direction of the trend. And they do give quite good risk to reward ratios. In all of the cases here, we're looking at triangle patterns, flag patterns, and wedges. They all give pretty good risk to reward ratios of at least 2 to 1 in most cases.
Because if you're, as a trader, if you're aiming for, say, 60% trades that are right and correct, 40% you're willing to get wrong,
yep.
I mean, that's pretty good stats.
It's very good stats, and you'll see as we go through these patterns and identify them, and then at the end I'll show you a basic summary of a risk to reward analysis of how you can see how beneficial it is to trade these patterns on an ongoing basis and how much it can skew your risk to reward ratio in your favor if you continually trade these trends whenever you see them.
Okay, so show us some examples, Garth. So you talk about triangles, flags, and wedges, and how you would use them, I suppose, in bullish and both in bearish scenarios.
Yes, so we're going to start looking at triangle patterns, and I've got a bullish triangle initially, which we'll talk about here. You can see that diagram illustrated on the left there. What is always useful to note in a triangle pattern is that there are typically 5 waves to a triangle pattern, as you can see labeled here, 1, 2, 3, 4, and then the 5th wave is usually the one that breaks out. That's important. There should always be 5 waves, ideally. If it continues to make more waves, then sometimes the pattern is not as valid. If a triangle breaks out, it should break out on the 5th wave of that pattern. The other important point to note is that if you take the apex, the boundary lines of these 2 triangle patterns and project them out to an apex point, you'll usually find that a triangle should break out approximately 2/3 of the way into the apex of that pattern. If that happens, that's the most high probability setup that is likely to then go on to meet its target. In terms of targets, you take the height of the triangle pattern at its broadest point, and you then take that distance and you project it up from where the breakout occurs to give you a target. The way you trade these is that you would then look to buy once the triangle breaks out in the direction of the trend. So right now we're assuming this stock was in a rising trend. It consolidates into the triangle, and then the assumption is that it breaks out in the direction of the trend, because remember, it's a continuation pattern. So you buy on the breakout. Once that breakout occurs, then you put your stop loss underneath the low of the 4th wave of that triangle pattern, as indicated over there. And then your target, as I mentioned, is the height of that triangle pattern projected to the upside. And that'll give you your target. And if you look at that from a risk to reward ratio perspective, you can see just by eyeballing this, and I mean, obviously this is something I've just drawn freehand essentially, but your risk to reward ratio there is favorable. Your reward is quite a bit bigger here than what your risk is. Your risk is the difference between where you would go and you would buy the triangle breakout and the bottom of where your stop loss is. That's your risk, and then the reward is the difference between your target price and your entry point. And as long as your reward is bigger than your risk, like it is here, that's a good sign.
What about flag patterns?
No, well, first of all, let's just talk about
okay,
we've got to talk about the bearish aspect as well, and then we've also got to look at an example of each as well. So here's a bearish triangle pattern. Here you can see again the stock is trending to the downside, and you've got waves 1, 2, 3, 4, and then it breaks down on the 5th wave. So it's everything as with the bullish pattern, except it's all in reverse here. And again, you would take the height of that triangle pattern at its broadest point and project it down to get a target. And you would trade this as follows. You look to short the break below the bottom of that triangle pattern. Once you've done that, you put your stop loss up above the top of the 4th wave over there, and your target is down here at the projection as I'd indicated. So once again, your risk to reward ratio, risk being the difference between where you go short and where your stop loss would be, the reward being the difference between where your target is and where you would enter that short trade. So again, a favorable risk to reward ratio. In terms of examples here, let's have a look at 2 examples quickly. This is a bullish triangle pattern in goldfields that happened in December of last year. And what's quite clear here is the triangle pattern that happened in December leading into January. There you've got your very clear 1, 2, 3, 4, 5 waves. It breaks out on the 5th wave, and also that breakout happens approximately 2/3 of the way into where an apex point would be for that triangle pattern. The target is taken as the height of that triangle pattern and projected up, and you can see how beautifully that target was met before the stock began to consolidate again. So you would buy the breakout through the top of the triangle there, stop loss underneath the bottom of that 4th wave, and your target is up here by the top of that green arrow. And quite clearly that was a triangle that worked out very, very nicely.
And similarly for a stock that you might have shorted?
Yeah, so this is a bearish triangle pattern that I'd identified on the FTSE 100 last year, and it was always looking quite promising for a break to the downside. And what you can see here is the FTSE 100 was trending lower into June and July. It then made the perfect 1, 2, 3, 4, and the 5 waves there, broke down on the 5th wave, and then we saw a very violent sell-off into August of last year. Again, you take your height of the triangle pattern at its broadest point and you project that down to get your target level. You'd go short on the break below the bottom of that triangle structure, put your stop loss up above the top of the 4th wave, and your target is down here where I've indicated with the red arrow. And that gives you quite a good risk to reward ratio, as you can see just in eyeballing the difference between your entry and your target point there.
Although I suppose at that, I mean, if you look at that chart, you know, your target would have cut you out of the trade too quickly.
Yes, look, what's also important to note is that these targets are minimum targets. Okay. Usually they'll get to those targets. Sometimes they can go beyond the targets, as was the case over here. But we always talk about this being a minimum target.
Okay. All right, then flag patterns.
Flag patterns, right. So we've got a bull flag and a bear flag pattern. And again, it's a continuation pattern within a trend. This is a diagram of a bull flag pattern. And a flag pattern is indicated with a consolidation that's demarcated by 2 parallel trend lines on either side of the consolidation, as you can see there. The flag itself forms, it kind of takes a slightly counter-trend pattern to it, if you look at it. So the overall trend is up here, but the direction of that flag is slightly to the downside. You get your target by taking what we refer to as the height of the flag pole. So it's from that bottom of the prior swing low to the top of that flag pattern there. Then you take that distance and you project that up from the bottom of the flag structure up to the same distance up, basically, and that gives you your target. There's a saying that flags often fly at half mast, and that is the reason for that is that if you take that flag structure, you can see that it's trading approximately halfway up from the bottom of the flagpole up to where the ultimate target would be. That flag is flying at half mast in this case. To trade these, you buy the breakout through the top of a flag pattern. You put your stop loss below the lowest point before that breakout occurred, and then your target is, as I indicated, it's the height of that flagpole projected to the upside. So again, your risk to reward ratio is favorable here. Yeah. The risk being the difference between where you go into that flag breakout and your stop loss, and the reward being the target minus the entry point.
And similarly, is it exactly the inverse?
For a bear flag, it's exactly the inverse as well. So here you're looking to trade a stock that's in a downtrend and you're looking to short it on a break below the bottom of the bear flag. Again, your bear flag pattern forms slightly counter trend to the overall downtrend. You would look to take the distance of that flag pole structure and project that down to get your target for a bear flag structure. To trade it, you would short a break below the bottom of the flag structure, put your stop loss up above the highest point before that breakout occurred, and then your target to the downside is, as I indicated, it's the distance of that flag pole projected down. And once again, if you're looking at it from a risk to reward ratio perspective, you can see there quite clearly that your reward ratio is bigger than your risk in this case.
Yeah. And once again, you've got a couple of examples to
So this is an example of a bull flag pattern that happened in First Rand this year. And what's quite interesting here and notable is that the trend of First Rand was very clearly upwards, as you can see over there. The stock formed this flag pattern, which lasted about 2 weeks in this case. Then you take the height of that flag pole from the swing low to the height of the flag structure. You then project that distance up to give you your target point. And you can see in this case here, that target point was met perfectly in First Rand before the stock began to then fall back again. So here you would buy the breakout through the top of the flag structure. Your stop loss is below the bottom of that flag point before the breakout occurred, and your target is as indicated by the projection there.
Yeah. And on the other side of the coin?
So a bear flag, here's an example of a nice bear flag that occurred in January and February this year in Woolworths. And there you can see quite clearly the trend for Woolworths was down. You can see the 50-day moving average is indicating the downward trend here as well. That's always a good measure to look at in terms of what is the trend. Look at the direction of the 50-day moving average. So here it was pointing to the downside, indicating downward momentum. Yeah. There you have this bear flag pattern that formed over about 3 weeks. You would take the height of that flag pole structure and project that distance down from the top of the flag structure to get your target. And then from a trading perspective, you short the break down below the bottom of that flag. Your stop loss is the highest point before the break down, and then your target is as I indicated over there. So a good risk to reward ratio is quite clearly evident just by eyeballing that chart over there.
Okay, so that's flags, triangles, and now wedges.
Yeah, no, so a wedge pattern, you get a falling wedge and a rising wedge. Now a falling wedge pattern typically occurs in a rising trend. That's the important thing to remember. So it's a little bit like the flag structure in some respects, except that your boundaries of the wedge are not parallel like they were with the flag structure. They're actually slightly pointing towards one another. So there you can see a good example of a falling wedge pattern. And you typically get your target by looking for a move back up to the prior high, or the highest point where the falling wedge began to form. So in this case, you've got a rising trend. The stock then consolidates into this falling wedge pattern. It then breaks out, and you basically look for a move back to the prior high as a minimum target for your falling wedge structure. To trade these, you would look to buy the breakout through the top of the wedge pattern, stop loss below the lowest point before that breakout occurred, and then your target is the previous high. That's a minimum target. And again, if you look at your risk to reward ratio there, it's quite favorable. You can see the reward undoubtedly quite a bit bigger than what the risk would be.
Yeah, and then a rising wedge, actually,
yeah.
It's sort of counterintuitive.
It is, yeah. So you think you've got to just remember falling wedge in a rising market, rising wedge in a falling market. The rising wedge pattern is a bearish continuation pattern. So you've got a stock that's trending lower. It then consolidates into this rising wedge structure before breaking to the downside in the direction of that prevailing trend. Again, you look for a move back to the previous low, where the point of where that wedge structure began to form, to get your target. From a trading perspective, you short the break below the bottom of the wedge structure with a stop loss above the highest point of that wedge, and you look for it to move back and make a retest of the prior low. And from a risk to reward ratio, again, you can see quite clearly it's a favorable risk to reward ratio.
And then just some examples quickly, because I know you also want to talk about the risk to reward ratio in a little bit more.
So let's have a look quickly at Aspen here. So here's Aspen in a rising trend. What's quite clear here is this little falling wedge pattern. This was in July of this year. A falling wedge pattern, which is a consolidation within that rising trend. You'd look for the stock to move back up to the prior high, which it did in this case. It broke out, so you would buy that breakout, look for a move back to the prior high, and you'd put your stop loss below the lowest point of that wedge structure.
And similarly on the other side?
And then, a rising wedge. Here's an example of a rising wedge in Netcare. So the stock was trending down. You can see your 50-day moving average pointing to the downside. You get this rising wedge structure, which forms as a consolidation within that downtrend. You look for a move back to the previous low when that rising wedge breaks to the downside. And here you've got your entry on the break below the rising wedge, your stop loss above the highest point, and then your target is back to the prior low as a minimum target.
And very quickly, Garth, just talk about the risk to reward, how it actually all pans out if you consistently take the sort of 2 to 3.
Yeah, I mean, if you took all of these patterns and you traded them consistently, you'll find that they generally work 2 out of 3 times on average, and that when they do work, you generally get at least a 2 to 1 risk to reward ratio in your favor. So what that means is that if you out of every 3 continuation patterns that you traded, 2 of them will work, and on those you'll make 2 units of risk, resulting in 4 units of total reward. And on one of those you'll lose, and you're going to lose 1 unit of risk. So if you took every single flag, wedge, and triangle pattern that you ever saw, on average, you would be, for every 1 unit of risk you took, you would make 4 units of reward.
Garth, we have to leave it there. I know you wanted to remind people about the mailing list, but they can go onto your website, they can click on to subscribe, and we'll be back next week with trades. Garth McKenzie is, of course, founder and editor of Traders Corner.